Hi, and welcome to our LinkedIn Live series on the release of the ISM Report on Business. My name is Dan Zeiger. I'm senior writer and copy editor for Inside Supply Management. That's Institute for Supply Management's member publication. And we're excited you're joining us today as we break down the Services PMI data for November. Now, the last time we were in this space, you probably remember it was Election Day, and we obviously have results with ramifications for the services sector and the overall economy that we'll discuss. But the data itself raised some of my eyebrows, or at least it did mine. 14 of the 18 services industries reported overall growth, 14 reported increased business activity, and 13 indicated new orders expansion. Yet the four sub-indexes that directly factor into the PMI dropped a combined 15.6 percentage points, with the composite index down to 52.1%. And I bet in the history of the report on business, that combination of circumstances doesn't happen very often. So with the holiday season upon us, let's try to crack that nut as we bring in Steve Miller. He's the chair of the ISM Services Business Survey Committee. Just Steve, what stood out to you about the November numbers? It was an interesting month, to say the least.
Hey, Dan, definitely an interesting month. So 14 industries were showing expansion, just like last month. 14 industries were showing expansion in their overall PMIs. But there was a shift in terms of industries that were in expansion mode versus either neutral or contracting. And that led to the differences in the overall numbers. We saw about, we weight numbers based on percentage of GDP for those industries. And we saw about 16% of GDP, industries representing 16% of GDP go from either from growth to contraction or growth to neutral. And we saw about 9% go from contraction to growth or neutral to growth. So it's just, I mean, maybe not very satisfying to say it's just math because it has to do with different segments of the economy and how many people and businesses are impacted, but in this case, it is that weighting factor. So even though 14 industries were in growth mode in both months, predominantly the impact was the shift in GDP represented by those industries.
Yeah, well, let's talk about one in particular. Real estate rental and industry, or excuse me, leasing. That industry had a challenging month, to say the least. It is the largest services industry by percentage of GDP, decreases in overall growth, business activity, new orders, and inventories. So, is that kind of the dynamic that you were speaking of? When that, that big of an industry, it's going to have kind of a pull down effect on the entire sector.
Yep, that's exactly right. That's exactly right. It's 13% of GDP. And for those of you who are out there who are in that industry and aren't yet participating in the survey, come one, come all. It's such an important factor in our reading of the overall economic direction. The more the merrier. We like to have as many surveys in really every industry, because the more that we get, the more representative it is of overall activity. But that 13% was a big chunk of that 16% swing.
Yeah, just from the respondents that we do have in that industry, I know I've seen some, reporting elsewhere, and I'm sure it's not a surprise that, the impact of the interest rate cuts that occurred in November. Maybe the impact has been delayed, or it's taking a little bit longer than expected. Certainly, that's something that real estate is feeling. What are some of the other dynamics that we may have heard from the respondents in that industry that made it such a difficult month in November?
In the real estate rental and leasing, funny, seasonality was a big one. As you get towards the end of the year, people make commitments. They're focused on their year end, and then they head on to to next year. We should see it bounce back if history is any indicator as to what the future holds. On the comment about about rates and rate cuts, we see. So we recently moved into a new house, and we went from a 2% to a 6% interest rate, actually 6.99. So the 6.6 3/4% is not a huge boon to the residential construction industry. In looking at how, and we're getting that in commentary, is that because interest rates, particularly around mortgages and lending, are staying high, those interest rate cuts are not really impacting business activity as much as they had hoped going in. I think one of our respondents, I believe it was in August, was optimistic about interest rate cuts, but they expected interest rates would have to drop, Fed rate would have to drop about 1.5 to 2% before they expected to see it flow through into mortgage rates. So don't know whether they're right or not, but so far they are.
Another impact that was easily noticeable on the composite number was supplier deliveries. That really stood out. The index number in November was 49.5%. That was 6.9 percentage points lower than the previous month. And that, of course, indicates faster deliveries when that index is under 50 because it's inversed. I'm sure we expected that many of the hurricane disruptions would be resolved. The port strike issue was resolved. But the fact that it went back into contraction and decreased by that much, was that kind of a surprise?
I can't say that I had a direct expectation in terms of the actual number, but certainly a significant reduction was expected. In retail and wholesale, they were prepared, at least all the information that we got, where they were prepared for a major impact from the port strike. And so we saw inventory levels going up and they were prepared. Well, it was a smaller impact, a shorter strike. And we're, 2/3 of the way through the retail season. So I think that combination of things, as well as, so many people that I've met through ISM and in industry are in the healthcare industry, and they don't go there primarily for, hey, let's make the most money we can make. Most of them, at least the ones that I know, are very much drawn to how can we contribute in an industry that's helping people. The performance of Baxter in getting their IV solutions manufacturing back up in such record time after being impacted by Helene, that was a major impact within healthcare, availability of IV solutions and inventories and such. Being able to get that back up and running so quickly is a real credit to them, and probably many suppliers and others that they worked with. But that, I think, is a big contributor because we saw a real negative impact in terms of speed of delivery from suppliers. They support, it's somewhere between 60 and 80% of the industry for IV solutions.
Yeah. Just as a tutorial to expand on what I was talking about in my question, for those of you who don't know, supplier deliveries is an inverse index, and the reason it is because the reading above 50% indicates slower deliveries, which, if you're talking about the economy, is a kind of a good thing sometimes, because that signals that demand is increasing. So that's why that index is inverse as it relates to the PMI. Another index that really caught my attention was the inventories index, and that was a big change month over month. The reading of 45.9% in November, that was down 11.3 percentage points compared to the previous month. But as you reminded us last month when we talked about it, you check the inventory sentiment index to see what the sentiment is there, and that actually went up to 54.6%, 1.6 percentage points higher compared to October. So the sentiment of the survey respondents was that their inventories were a little too higher than they were the previous month. Just talk about that combination there, and just what were the panelists trying to say?
Yeah. So Dan, that was the big surprise for me. In seeing that inventory number go down so far and inventory sentiment go up. We'll see with retail sales whether, to me, my immediate kind of thought is that, okay, retail and wholesale, although positive in November, may be looking at what is coming up and inventories that they have to support that going into the end of the holiday season and the start of the next year. Because you get your inventories way down, but then you look at, okay, they're still higher than I want them to be. Retail sales for the first month, very good. Would be drawing inventory down. So a reduction, not necessarily an indicator on how much of a reduction it's been, but that inventory is down as peak is being worked through. That'll make sense in terms of a very high percentage, but it's a bigger number than historically. So that's something definitely want to keep an eye on and see if in next month's comments we get a sense for what has happened there.
Yeah. Obviously, it's been a talk, and we'll dive into tariffs a little bit more and the policy that could potentially be coming in 2025 as a result of the election. But it's just a question that just came to my mind as we're talking here. Obviously, you hear that a lot in the manufacturing sector about potentially bulking up on inventories and orders to potentially get ahead of tariff increases in 2025.
Right.
Is that as big a deal in the services sector? And the reason that I ask is I just glanced down to the imports index, and it did go up 3.6 percentage points to 53.8%. Just any sense in the services sector that that's a big deal, or at least as big of a deal as you would hear about in the manufacturing sector about potentially ordering ahead to get ahead of any tariffs?
Yeah, it's not as big of a deal.
Yeah.
In the services sector, but we did see commentary that supported that increased reading for imports, precisely for the reason that you mentioned. Uncertainty around the tariffs, not panic, not hair on fire kind of stuff, but because of the tariff commentary was so strong within the survey responses this month, I kind of went through and looked at, okay, what industries are those comments coming from? And back to GDP, we had 52% of GDP represented by industries that had comments, concerns about potential tariff impacts. I did a little bit more kind of background research and okay, well, how big of a deal is this? And we went from about somewhere between 20 and $40 billion a year in custom duty revenue to the government from about 10 years ago to $80 billion 2 years ago to $100 billion in 2024. So the additional tariffs that the Biden administration put in due to some bad behavior, specifically around China, the tariffs duties went up to, I believe it's $100 billion in 2024. The U.S. economy is $27 trillion. So we're talking about 100 billion of 27 trillion. So less than half. What is it? Do the math for me. It's a small number.
That's a big ask of me to do math like that on the fly.
Yeah, it's a small number, and then you look at overall government revenues of over $5 trillion. It's $100 billion of over $5 trillion. So that rough math is 2%. And then when you look at government spending, which is as a percentage of GDP, the highest it's ever been. At I think it's 23% of GDP. That's more the issue. I mean, that's not the tariffs. 50% of government revenue is individual or private income tax. So that to me is much more important than going from 2 to 3% of tariffs as input costs. Another thing I'd add, Dan, just because it's one of the fun things that I got to experience during the first set of Trump administration tariff increases on China, is do what we always do: understand your should costs, because people are banging down your door to tell you how much their costs are going up because of those tariff increases, and then you go, okay, so you went from 5% to 30%. on something that makes up 6% of your cost of goods and you want a 10% increase? Help me understand the math here. So that's, I mean, that would be my encouragement is in terms of preparation. You know, we all, as senior supply managers, our jobs are to find out places where we can be negatively impacted, worry about those, and then do something about them. So I'm not saying don't be concerned and don't be action oriented around potential tariff increases, but there are certain actions that I think would be more helpful than others, and making sure you understand what percentage of cost those tariffs really have the potential to impact would be where I would focus my time.
Yeah, let me expand on that. Feel free to expand on that a little bit. That was one of the questions that I had for you. I mean, just in general, I mean, how much, tariffs anxiety do you expect among some of the services community? And you had mentioned some of the actions that were taken during the first Trump administration. I mean, companies have a playbook now, or they should have a playbook based on what happened from 2018 and beyond.
Yeah. So a lot of the major impacts will come, I think, from if it's not just a negotiation tactic, it's actually something that gets implemented. Then what we have is a trade war, and then we have products that aren't getting purchased, which I think has a much more significant potential impact to our economy than what the tariffs could impact. We see here, and I'm not an expert in this. I'm just seeing, what I'm seeing and what I'm reading in the news between Wall Street Journal and CNBC and that type of thing. The tariffs, a lot of the discussion is around finished goods. When we're not talking about China, we're talking about finished goods from Canada, finished goods from Mexico, agricultural products from Canada. The agricultural products, we had a couple of our respondents talk about worry there on particularly with China. If we raise tariffs on China goods, them coming back at us with tariff restrictions or just general import restrictions, which we saw last time. And it wasn't, we're going to increase tariffs coming into China. It's, oh, we're not so sure the quality of your products are safe for our citizenry. We're going to stop imports. Huge impact. But I don't know that I've given much conclusive information in those kind of random thoughts. But I think much more so than the tariff impact on imports, steel will be impactful if we go higher on that. Certainly other construction materials and things that we have right now that are either increasing in pricing or on shortage, things like transformers, power distribution, electronic components, things like that much of that comes from China. I think those are the areas where I'd also be taking a sharp eye to what are my alternatives. Dan, my last comment on that one is one of our respondents said, even with the tariffs, lead time is half and products are still cheaper.
Yeah, I noted that comment. Talk about just in general. I mean, a lot of the sentiment after the manufacturing data was released on Monday was that, with the election results settled, at least we'll have some clarity on, the tax and the regulatory policy that we're going to get in 2025. And some of the sentiment that, I sensed in the services comments and some of the reports that we've seen are, after the data came out, some of the news organizations picked up on that. Services panelists kind of are thinking more wait and see, and there maybe is not as much certainty as to what might come. Did you sense that in going through the comments?
Yeah. I'd say exactly that. Yeah.
Mm-hmm.
Yeah. Nothing. No definitive actions. No conclusion. Just wariness.
Yeah. One of the Other dynamics that has been talked about a lot during the campaign was immigration, and I'll ask it. It may be a little too soon, but I'll ask anyway. I mean, when people are talking about the aggressive immigration policy and potentially deportations that the Trump campaign promised. I think most people point to agriculture as the industry that would be most impacted by that, but it was pointed out to me when I was talking to someone yesterday that there are a lot of other industries that could potentially be impacted. Obviously, some of them in the services sector. Like I said, it may be a little too early, but any sense among the survey respondents, that there may be some potential concern about immigration policy and how that could impact their employment?
Yeah, Dan, the only place we specifically got a comment on that was in agriculture.
Yeah.
The best thing that I can attribute or kind of analogy that I can create is like the impact of minimum wage increases.
Mm-hmm.
So many industries, minimum wage increase, we're already paying people, $10 an hour above minimum wage. But it still impacts us because other people who are not get drawn into the market, which makes our incremental cost go up in terms of our ability to attract people to difficult jobs. Agriculture is a really difficult job. Construction, difficult job. A lot of the food service are difficult jobs. Working Saturday, Sunday, busiest times are Friday night and Saturday night, times when you really want to be off and doing something like all of the customers are. And so when you see a chunk of labor leaving the market or potentially leaving the market, that certainly is going to have some inflationary pressures and some availability pressures. If it's approached the same way as historically as one-off type actions. So Condoleezza Rice was a speaker. I believe it was at an ISM conference probably 15 years ago. And somebody asked her the question of, when do you think immigration is going to get fixed? Immigration policy. And she said, fortunately, I'm not going to be in politics anymore. It's never going to get fixed. Or it's going to take something very difficult to happen in order for it to get fixed. Because, and this is my recollection, probably not a direct quote, because people run on issues. And as soon as the problem is fixed, they can't run on the issue anymore. How long have we been talking about comprehensive immigration reform? We've got people that have worked here for 6 years, can't get a green card, PhDs from Stanford, hard workers in agriculture and real estate, from the rental business all the way to construction. And we just don't fix it. We just take one little piece at a time, make it a campaign issue. If we're lucky, the person that gets elected has an issue that we like, and they actually fix one modicum, tiny piece of the overall issue. But is a slim majority for either party ever going to result in us fixing the immigration policy overall? And I think it's going to be a continuing issue, and unfortunately, people in the more sensitive industries are going to get impacted by it. Yeah.
Well, let's talk about the current employment picture. The employment index. It was an expansion again for the fourth time in 5 months, 51.5%. But it continuing mixed bag in the comments. I mean, there were comments about we're hiring people, and there were also comments about we're freezing people. So continue a diametric there. But the fact that it's expanded 4 times in the last 5 months, I mean, is that an encouraging sign of resiliency?
Yeah, absolutely. Yeah. Absolutely. I think it is. And I think we're seeing that in even revised numbers, slightly anemic, but relatively encouraging increase in employment. There was some other positive commentary in the results that were around industrial policy within the incoming administration, whether that'll be positive for business, whether some of the tax actions will be positive for business. and all of us who have been in annual planning activities, it's about hitting an operating income line and being able to show growth in terms of revenue and profits. If we're not paying as much taxes, we've got other dollars available to help with growth. And if there's some type of a tax reform which is growth generative, I think that could be a really good thing from an employment standpoint. We're at a place where it looks like availability isn't being commented on as much. Is that because there's more availability, or is it because people are tired of commenting about not having construction labor available, not being able to get skilled trades, things like that? I mean, we'll see as hopefully the economy heats up at the beginning of 2025.
Yeah. Well, yeah, we're coming down to the bottom of the hour here, so I'll just take this opportunity to say if there's anything that I didn't ask or anything that we haven't talked about to this point that you think might be important this month. And I know I asked you this last month going into the holiday peak season, but now that we're kind of in at full bore at this point, I would say just to give us an overall read of the services sector at this point.
Yeah. So Dan, a couple of comments. One is on prices. Our 58.1, I think, or 58.2 reading for prices is just above the 12 months trailing, below last year, and almost 20 points below 2021 or 2021 and 2022. We're not seeing inflation creep through in prices. So I think even with moderate growth, the price indicator is saying we can afford additional rate cuts to help the economy build more next year. The second thing I'll say, which is another, I think, reinforcement for why I think that's a good idea to continue with the rate cuts, is that with a reading of 52, in the range of 52 for the average, not including the last 2 months, or the high points, even looking at those last 3 months, September, October, November, what we see in the summer following the September, October, November ratings is we see anything from a 0.5% increase to a 6% decrease. And it's pretty even distribution across that. What that could say to us is that we might be around 49 or 48 next summer, like we were in June. That's a concerning figure. You look at the next 3 months, next 6 months, doesn't look like a concern the way the numbers are coming in. But if we see the kind of drop from now till mid-year next year, like we've seen in non-COVID years, we could see a really slow economy in the summertime. And hopefully there'll be some things that are done by the administration as well as the Fed between now and then that keep us out of a contraction period.
Yeah. Well, that's an interesting point to make to close us with. It'll lead me into something that I definitely want to remind our viewers of. Mark your calendars for December 16th. That's when ISM is going to release its supply chain planning forecast for the manufacturing and services sectors. And the report will detail recent performance and, perhaps more importantly, a lot of what Steve just talked about, sentiments for 2025 and some of the impacts that could have not only on the respective sectors, but on the overall economy. That report gets released, as I said, on the 16th. And then on December 18th, I'll join Steve and Tim Fiore, the chair of the ISM Manufacturing Business Survey Committee, for a LinkedIn Live broadcast to break it all down. So thanks for joining us today. And for more information, feel free to go to ismworld.org, where in a little bit you can read our roundup article that details a lot of what Steve and I discussed here. And if you'd like to be a part of the manufacturing services or hospital business survey panels that help compile data for the report on business, visit ismworld.org/join the panel for more information. So we'll see you back here after we've turned the calendar on 2025 and we break down the December ISM report on business. So for Steve Miller and some people who helped us behind the scenes today, Christina Cahill and Jennifer Stevens, my name is Dan Zeiger. Have a great holiday. We'll see you next month.